Welcome to The Explainer. Today, we're diving into a really groundbreaking financial model, one that seriously challenges decades of what we thought we knew about the stock market.
I mean, for decades, right? Academics, investors, everyone has been on this quest to answer one single massive question. But a simple answer? It's been tough to find. And that's led to this constant search for a better model, a better way to explain the beautiful chaos of the market.
And that search, well, it's led us to what you could call a title fight. In one corner, you've got the reigning champ since the 90s, the famous Fama French three-factor model. And in the other corner, a powerful new challenger that's built on how companies actually behave in the real world, the Q-factor model.
All right, first up, let's talk about the reigning champ. And, the puzzles that started to show some cracks in its armor.
Look, the Fama French model was absolutely revolutionary, no doubt about it. But over the past 20 years or so, researchers just kept finding these weird market behaviors that the model couldn't make sense of. Things like the momentum effect, the idea that winning stocks just keep on winning. That was a total mystery. They called these anomalies, and believe me, the list just kept getting longer and longer.
So you can see why a new model was needed. And that brings us to the challenger, the Q-factor model. It comes at this whole problem from a completely different angle. And honestly, it's maybe a lot more intuitive.
So, what's under the hood? Well, the Q-factor model keeps the classic market and size factors we all know, but it adds two new secret weapons. And these aren't just pulled out of thin air. They come from basic economic principles, investment and profitability. Let's break down how they work.
Okay, this first one is surprisingly intuitive when you think about it. Picture a company that's really cautious about spending money on new projects. Why would they be so careful? Well, probably because their cost of money, what we call the cost of capital, is high. And that caution means they're only going to greenlight projects that promise a massive payoff. For you, the investor, that signals higher risk and therefore a higher expected return on their stock. Makes sense, right?
And the second new factor? Just as straightforward. Companies that are more profitable, generating more earnings from their equity, are naturally expected to deliver better returns to their shareholders. It's a really direct link between how a company is doing in the real world and how its stock performs.
And this is the really crucial part, coming straight from the authors themselves. They didn't just stumble upon these patterns by crunching a ton of data. No, they built their model from the ground up, on the fundamental principles of how businesses actually run, all rooted in something called the Q theory of investment.
Okay, so to prove it was the real deal, this new model couldn't just sound good on paper. It had to step into the ring and face down every single known puzzle the market could throw at it.
So the researchers, Hu, Su, and Zhang, did something pretty wild. They compiled this massive list of nearly 80 different market anomalies that had been documented over the decades. This was going to be the ultimate stress test.
But before they could even get to declaring a winner between the models, the researchers found something really shocking, something about the anomalies themselves.
Get this. It turns out that more than half of these so-called anomalies were, well, they were ghosts. They just vanished when they were tested properly in the broader market. A lot of them were just statistical noise, or they only showed up in tiny illiquid stocks nobody could really trade. So that left them with 35 real anomalies that actually needed an explanation.
All right, so now for the final scorecard. With the field narrowed down to those 35 real market puzzles, how did the models stack up head-to-head?
So what we're looking at here is the average unexplained return, the alpha, for each anomaly. Basically, a lower number is better. It means the model's explaining more. And look at that. The Q-factor model's leftover alpha was just 0.20% per month. That is less than half of what the classic Fama French model left on the table.
And this chart, wow, this really tells the story. The Fama French model, it failed to explain 27 of the real anomalies. The Carhart model, which you might know adds a momentum factor, still left 19 unexplained. But the Q-factor model, it knocked it out of the park, explaining all but 5. I mean, that's a clear, decisive victory.
So the author's conclusion here is pretty profound. They realized that dozens of these puzzles that seemed totally unrelated, everything from momentum to value, were actually just different sides of the same coin. They were all just different manifestations of two simple core economic ideas: how companies invest and how profitable they are.
So this is the really crucial part, right? We need to understand how this new model gives us a clearer picture of the market. It's not just that it performs better, it's about why it performs better. Yeah, the model gives us this really elegant framework. Think about a puzzle like momentum, which has stumped economists for years. Well, it's largely explained by that profitability factor. Winners are often just more profitable companies. And what about the classic value versus growth debate? That's mostly explained by the investment factor. You see, value firms tend to invest less, which implies they have a higher cost of capital, and that means higher expected returns for investors.
Now let's be clear, it's not a silver bullet. The researchers are very upfront about this. While the model is a huge leap forward, especially with momentum and profitability, it does still struggle to explain a few very specific anomalies, things related to operating accruals and R&D spending.
And this isn't just some dry academic debate over formulas. This new model really fundamentally changes how we can think about the entire market.
So what's the big takeaway here? It's that stock returns aren't just some abstract thing happening on a screen. They are deeply, deeply tied to the tangible, real-world decisions that companies make every single day. How much to invest in a new factory or a new product, and how well they turn all that investment into actual profits.
And that leaves us with a final, really fascinating question. If we can explain these anomalies, does that mean the market is actually more rational than we gave it credit for? With stock prices correctly reflecting the real risks of investment and profitability? Or does this just give us a better map of the market's irrationality, showing us predictable ways that investors mess up and misprice stocks? That debate, well, it's far from over.